Hello, and welcome to our discussion today on the Federal Reserve's path as we navigate slowdown concerns and the threat posed to policymaking by artificial intelligence. At its September 2025 meeting, the Fed lowered the federal funds rate by 25 basis points to where it now stands at 4 to 4.25%. In doing so, it has shifted its attention to the fragile state of the labor market as well as to addressing potential threats in line with the data. Our discussion today is going to come in three parts. We're going to begin with an overview of economic conditions. We're then going to move into an in-depth discussion on uncertainty, mainly to do with artificial intelligence and data reliability concerns. And we're going to wrap up with a recommendation for a 25 basis point cut at the upcoming October FOMC meeting, as well as a recommendation for cautious policymaking in line with the data.
First, we cover current conditions. To begin, the labor market has slowed down considerably, with the unemployment rate being at 4.3%, its highest since the pandemic. In addition, we're seeing that recent job revisions are indicating further weakening, with the BLS's annual benchmark estimate this past September subtracting 911,000 jobs from previous payroll estimates. Job openings are also declining substantially, and the vacancy to unemployment ratio has normalized to pre-pandemic levels, implying that the relatively tight conditions in the labor market from 2022 and 2023 have eased. However, the unemployment rate of 4.3% remains in its historical range. This is more in line with the natural rate of unemployment, which the Philly Fed forecasts at 4.25%, and the Congressional Budget Office's estimates even slightly exceed the figure. Broader structural factors do also complicate our outlook. The employment rate is at 59.6%, well below its 2008 levels. Furthermore, the lagged effects of monetary policy imply that current restrictive settings may have longer-term effects on hiring.
The other half of the Fed's dual mandate, price stability, shows progress but remains incomplete. Since January 2021, wages have increased a cumulative 21.8%, but have slightly lagged inflation levels, which increased 22.7%. Over the past year, however, this gap has shrunk as inflation has stabilized while wage growth has caught up. As you can see in the graph, inflation has moderated but remains above the Fed's 2% target. Headline PCE is at 2.6% and core PCE at 2.9%, both well below their previous peaks.
Encouragingly, disinflation has broadened across sectors. This is particularly visible in interest-sensitive sectors such as housing, as shown by the new tenant strength index. Lower-income households who bore the brunt of major 2022 food and energy price increases particularly benefit from this easing. Supply chain pressures, which were once a major driver of goods inflation, have largely normalized. This helps long-run inflation expectations, which remain currently at around 2.3 to 2.4%, relatively stable and well-anchored. However, shocks such as tariff cost pass-throughs or faster-than-expected productivity gains from artificial intelligence could put upwards pressures both on inflation and its expectations.
In terms of economic growth, real GDP swung from a 0.5% correction in Q1 to 3.8% growth in Q2, which was the strongest pace in nearly 2 years. This rebound was driven by revisions that showed stronger consumer spending, as well as a slowdown in import growth, which was the main drag we saw in Q1. Importantly, as the bottom right graph shows, underlying demand never truly weakened as real private domestic final purchases, our best measure of core domestic demand, has been relatively stable at around the 3% level since 2023. This may suggest that the economy has been more resilient than just looking at the swings in GDP may suggest. Looking ahead, the Fed's latest SEP projections point to growth near the country's long-term potential of 1.8%, indicating moderating but still solid growth ahead.
The imposition of tariffs under the current administration is also complicating the monetary policy outlook. Increased costs for import-reliant industries have led to concerns about drag on investment and global demand. However, import price indices show no year-on-year change from August 2024, indicating that global supply adjustments and competitive pressures have mainly offset the tariff impact. As you can see on screen, it seems like unlike the impact of import prices during the COVID pandemic, tariffs are having no direct strong impact on imports or exports. This indicates that firms are mainly bearing the tariff impact, either in the form of front-loading their imports or in the form of cutting into their profits. However, recent papers by Cavallo et al. Indicate that if there is to be a pass-through to consumers, it will come in the form of a one-time price shock 6 to 8 months after the implementation of tariffs. This leads us to a more granular look at the data to make a strong conclusion.
Since the imposition of sweeping tariffs in Liberation Day of this year, we have seen that manufacturing job losses have increased substantially, with 42,000 job losses this past August. However, we believe this is more due to firms adapting to higher uncertainty rather than actually facing higher marginal costs. A key concern of this delayed pass-through of tariffs to consumers is that it may fuel more persistent inflation expectations. If firms and consumers begin to expect higher levels of inflation, these expectations may become more embedded in price and wage-setting behavior. In that case, the Fed may have to lean against persistence in above-target inflation to ensure that expectations remain anchored, which may limit its ability to deal with the weakening labor market. Broader global relations also heighten risks. The expiration of 2.7 million visas by 2027 may tighten labor supply and slow hiring, while broader geopolitical conflicts could lead to commodity shocks and weigh on confidence. In fact, global trade policy was the most cited risk in an April 2025 New York Fed survey among firms.
We now turn our focus to another key source of uncertainty for future policymaking, which is that of artificial intelligence. The impact of AI on the real economy continues to grow. AI capital expenditure is estimated to account for a third of GDP growth for the second quarter of 2025, while the IMF estimates that 60% of jobs in advanced economies could be impacted by AI. The integration of AI is likely to have very strong effects on our economy. As Governor Barr has noted, a more gradual integration of this AI technology could lead to fewer disruptions, while a more rapid and widespread integration could lead to greater risks, such as job losses, wage polarization, or adverse price effects in sectors with inelastic demand or supply.
Multiple papers have analyzed the relationship between artificial intelligence and the labor market. Research by Echemoglu opted for a more theoretical approach. Using Holden's theorem, he calculated the aggregate effect by calculating the average cost saved per task and the share of tasks impacted by artificial intelligence. Ultimately, he concluded that while microeconomic productivity gains are impressive, the effect on the overall economy seems to be more modest. Similarly, research by Humpel has found that artificial intelligence might have a more muted effect on the labor market, as the substitution effect is being offset by effort reallocation and complementary labor demand driven by artificial intelligence. At the same time, a recent study by the St. Louis Fed has found positive correlation between a job's AI exposure and sectoral unemployment. If AI were to accelerate unemployment at a faster than expected rate, monetary policy might have to adopt a more aggressive rate-cutting trajectory. It is also important to note that AI could widen inequality. A survey by the Bureau of Labor Statistics has found that by 2033, up as much as 5% of current tasks could be replaced by AI, while only 4% of jobs could be added.
The presence of artificial intelligence makes it important to have a data-grounded approach, but increasing unreliability in data complicates this outlook. There are three key concerns here. The first concern has to do with falling response rates. For example, the University of Michigan's sentiment survey has seen falling year-on-year rates, meaning that the data readings are noisier. The second concern has to do with budgetary constraints, including the ongoing government shutdown at time of presentation, which means that the Bureau of Labor Statistics is constrained and there is a growing reliance on imputed or predicted data for the purposes of policymaking. The third has to do with alternative data use. For example, reliance on the New York Fed surveys. However, smaller sample sizes means that data could potentially be noisy at worst and at best not represent the full situation. This is where machine learning techniques might be helpful through the creation of richer data sets, through web scraping prices, for example. But the use of artificial intelligence comes with its own risk due to the hallucination problem, meaning that artificial intelligence can misrepresent or miscreate data where it does not exist. So the use of these tools needs to be carefully monitored and gauged with uncertainty.
Turning to financial conditions, they remain supportive of growth but may be underpricing risk. The NFCI has gone further into negative territory, signaling looser conditions. Credit spreads have narrowed, overall pricing suggests elevated risk appetite, and the equity market is at stretched valuations. However, this increase in equity prices seems to be concentrated among higher income investors, meaning that the transmission to the real economy is weaker and that conditions may appear looser than they actually are. The VIX, a key gauge of uncertainty, has fallen sharply from its Liberation Day peak earlier this year. This decline suggests that markets see less risks and more financial stability. Overall, while conditions are supportive of growth, we should remain cognizant that they are still vulnerable to things such as fiscal stress, trade shocks, or a potential AI-related correction that could rapidly tighten conditions and pose downside risks to the outlook.
The 10-year term premium has fallen from about 80 basis points in January to 50 basis points in October. While this is a notable drop, as you can see in the graph, this remains elevated relative to pre-pandemic levels when it was often near zero or even negative. This persistence isn't only explained by inflation and growth expectations, but also by supply-demand imbalances. Treasury issuance now makes up nearly half of all U.S. fixed income net supply, owing to large deficits. At the same time, the Fed is reducing its balance sheet, and foreign demand is softening. With fewer passive buyers, marginal investors now demand more compensation to hold long-duration treasuries, which pushes up the term premium. This, in turn, raises long-term yields, which tightens financial conditions and also raises borrowing costs.
While the term premium does account for some of the recent rise in Treasury yields, R star, or their natural rate of interest, anchors the long-run real rate of interest and governs Fed's neutral policy. However, the R star is unobservable and estimated with significant uncertainty. Models like Lawback-Williams suggest that R star levels remain quite low, largely due to structural factors such as aging demographics and slower population growth. However, we believe that opposing forces are emerging. Chow, Halperin, and Maslish argue in a 2025 paper that transformative AI may increase long-run productivity and boost economic growth, raising the level of R star over time. We believe that some of these dynamics are not yet fully captured in current R star estimates. This uncertainty around R star reinforces the need for a more cautious policy path. Cutting rates too aggressively could overstimulate the economy if R star remains lower than expected, while failing to acknowledge upward pressures such as AI and term premium normalization could risk keeping rates too unrestrictive.
Building on our discussion of the general economy, we now turn to our monetary policy recommendation. First, we recommend a 25 basis point cut at the upcoming October FOMC meeting. Second, we recommend continuing the current pace of balance sheet normalization. And finally, we stress the importance of remaining data reliant in light of increasing uncertainty.
Overall, the Fed faces a clear trade-off between prioritizing unemployment or inflation. Recent empirical research done by the Chicago Fed suggests that this trade-off has increased as the Phillips curve appears to be steeper than before the COVID recovery. In terms of inflation, it is well below its peak, with expectations anchored around the 2.3% level. On the other hand, the labor market has worsened, with the unemployment rate reaching its post-pandemic high and NFP releases being revised down significantly. The Fed also tracks Taylor's rule and R star to determine the neutral level of the federal funds rate. According to the Atlanta Fed, Taylor's rule prescribes a federal funds rate of roughly 3.9 to 4.2%. Estimates of R star range from 0.84% under the Holson-Lawback-Williams model to 1.37% under the Lawback-Williams model. Both of these approximations imply that the 4 to 4.25% rate is moderately restrictive, supporting our case for gradual easing ahead.
However, we find that a 50 basis point reduction would be too excessive for several reasons. First, while labor market conditions are deteriorating, we do not yet see the need for emergency action. For example, while unemployment rate is currently at 4.3%, its highest since post-pandemic, it remains close to its natural rate. Additionally, core PCE stands at 2.9%. As Chair Powell has emphasized, too quick easing could lead to difficulties reaching the 2% inflation rate target on the long term. Finally, a 25 basis point reduction allows us to be more flexible as we monitor incoming data. Therefore, we commit to a 25 basis point reduction to 3.75 to 4% at this FOMC meeting.
Lastly, we turn our focus to the Fed's balance sheet. In order to continue the transition from abundant to ample reserves, we recommend that the Fed continue its current pace of balance sheet normalization, letting $5 billion of treasuries and $35 billion of MBS expire each month without reinvestment. Determining the level of ample reserves is an ongoing task, but several indicators provide guidance. First is a survey of market expectations, which indicates that QT could end in January 2026 with $6.1 trillion in balance sheet holdings and $2.9 trillion in reserves, consistent with around 10 to 11% of GDP. Furthermore, Governor Waller has suggested that ample reserves could be 9% of GDP, which is slightly below today's levels of $3 trillion. Finally, looking at ONRP usage, its declining levels are consistent with excess liquidity draining out of the financial system as we shift back to ample reserves. Overall, the Fed should continue to monitor money markets in order to ensure a smooth transition back to ample reserves, which is essential for the effective conduct of monetary policy. This concludes our presentation. Thank you for your time, and we're now open for any questions.
Thank you for your presentation. Very interesting. So we've seen monthly gains in jobs move sharply lower this year relative to last year's period, while at the same time, the unemployment rate has only moved up a bit. How are these observations consistent, and what are the implications for monetary policy?
I can get started on this question. The main thing to consider when we're looking at a mostly stable unemployment rate while job increases are not as good is to think about the fact that both demand and supply are decreasing. The reason why we are seeing unemployment is because there's been such a large decrease in demand. One way we can think about this is that underemployment numbers are also up. So if we've looked at the BLS's statistics for number of individuals outside the labor force who are looking for a job, that number has sharply picked up. If it was simply the case that people are leaving the labor force, we would not see these numbers pick up. We would see these numbers remain relatively stable. So it is clear to us that there is a demand decrease. However, at the same time, there is a supply decrease. One main factor there has to do with immigration. We've talked about 2.7 million visas expiring, but in addition to this, there is uncertainty around immigration policy. The fact that there is an ongoing tension around immigration means that the number of immigrants and foreign-born workers in the workforce have steadily declined, even though the unemployment rate has remained stable. This indicates these individuals are not simply becoming unemployed, but leaving the workforce altogether. This data together compounds to give us a situation we're looking at while still allowing us to see a fragile labor market. I can let one of my colleagues take it from here.
We would also like to highlight the unique experiences faced by vulnerable to lower middle income households in the labor market. Since the spring, latest readings have shown that the youth and Black unemployment rate has actually steadily increased, and this also mirrors financial strains they are facing. We believe that this represents a two-speed economy where the well-off are doing well and lower to middle income households aren't. Even though monetary policy decisions are made with a broad view of what is happening in the economy and is not targeted to a particular demographic, we believe that it is important to note this and that by delivering on our dual mandate, we will be able to achieve the best outcomes for all Americans.
Additionally, monetary policy implications mean that we must consider both inflation and labor as part of the dual mandate. Compared to the post-pandemic recovery, the Beveridge curve was steeper before, meaning that vacancy to unemployment could fall while unemployment did not move as much. But now with vacancy to unemployment at 1, combined with the steeper Phillips curve, this means that there's a greater trade-off between inflation and labor risks. While we do see more downside risk to labor, which is why we recommend 125 basis point cut, because of this trade-off, we push back against a 50 basis point cut in order to preserve flexibility.
Thank you for these very helpful answers. Want to talk a little bit about financial conditions. So how should, again, it's a two-part question, just so you can get your brains around that. How should policymakers take into account signals from financial markets, such as stock valuations and credit spreads, when deciding on the appropriate stance of policy? And if changes in financial markets have different implications for monetary policy and financial stability, how should policymakers weigh the trade-offs?
First, to provide an overview of financial conditions, we would like to note that the NFCI has gone further into negative territory, signaling looser conditions. Furthermore, the S&P right now has a PE ratio of around 30, with the historical average around 20, signaling that the market has a lot of confidence in future earnings. But this does highlight some vulnerabilities, such as if there is a correction, like a lot of investors have high expectations of what is to come in the financial market. Furthermore, in terms of credit spreads, we do see the high yield credit spread at around 3%, which is a lot lower than historically. We would also like to mention that the rise in the financial market is mostly related to AI companies, with Mag 7 comprising of over 1/3 of the S&P 500. And that is just a broad overview of financial conditions. I can let one of my colleagues further elaborate on this response.
One clear way to think about the interaction between financial conditions and Fed policy behavior is through R-star. So some research by President Williams has shown that although financial indicators and R-star are correlated, there's no predictability between the two. So if we think about, in general, certain indicators in the market, like tip spreads and other indicators such as that, those may be correlated with R star, but we can't use those types of market expectations to directly infer levels of R star.
One thing that could further increase financial stability is the implementation of central bank digital currencies, or CBDCs. This is currently already in use between the Federal Reserve and commercial banks. However, with improvements in technology, there's a potential that this could be extended to the general public. Unlike cryptocurrencies or stablecoins, the value of CBDCs would be provided by the Federal Reserve, which would provide stability to this method. In addition, the implementation of CBDCs would allow the Fed to have a better, more efficient monetary policy, as it could affect the money supply more effectively. It could also provide more incentives to consumers to either invest or save. For example, it could, by tracking each CBDC individually, it could implement devaluation after a certain time if the money isn't spent, therefore creating an effective negative interest rate if that is to be needed. However, CBDC has to be carefully implemented because there are huge privacy risks. Therefore, we have to adopt a privacy in mind approach as recommended by the International Monetary Fund.
In addition to what my colleagues have said, I'd like to make reference to a recent speech by Governor Waller that spoke about the distinction between hard and soft data and the relevance that financial markets can pose. In instances where the financial market seems to deviate from public sentiment, it's important to recognize what financial markets signal, which is that individuals and large corporations are staking claims on particular outcomes with large amounts of funds at high levels of risk, meaning that there is a significant level of confidence that those should return. It's important to take this into consideration, and the consideration we should have is between that of hard data and soft data, in order to ensure that what we're seeing from the market is actually valuation and not simply speculation or anything of that sort. And there are means we can use to do this by being more granular at what specific metrics we look at and looking at where the largest investors are putting their money.
Lastly, when we think about the connection between financial markets and how this impacts monetary policy, it's important to note that while the Fed is monitoring financial markets for growth and stability, just the tool of interest rate policy is a bit too blunt to target this more specifically. In order to address stability concerns, regulation of financial markets and banks is a more targeted tool that's more effective than merely setting the interest rate.
Thank you.
Thank you very much. I would like to touch on a part of your presentation that caught my attention. When you were talking about artificial intelligence, you mentioned that artificial intelligence can increase inequality. Can you further elaborate in what channel you have in mind, and if there is anything for monetary policy to do in this scenario?
Yes, I can get started on this question. The main thing we're thinking about is what specific kinds of jobs are going to be replaced with artificial intelligence and what specific jobs are going to be created. As the statistics have shown from the BLS, it is estimated that by 2033, artificial intelligence is going to remove 5% of all tasks from the labor force while only adding 4%. The vast majority of these tasks are likely to come from the lower middle class, that is to say, individuals working in sectors that are service or data oriented, but that do not have such a high specialization of work. This indicates that this is a large portion of unemployment we need to consider. However, it is important to note that the majority of these impacts are likely to be structural, that is to say, long-term changes that influence the underlying basis of our economy. What monetary policy has the capacity to do is to smoothen out the transition to make sure that job losses are not too hard, but fiscal policy might be necessary to actually correct for the long-term impacts of this. I can let one of my colleagues take it from here.
We also agree with Vice Chair Jefferson's view that the net effect of AI on unemployment is still a little too soon to tell. Whether AI complements labor or substitute for it is still a question that needs to be answered. Luckily, we have seen some good signs, such as a recent survey by the New York Fed suggests that firms are retraining their workers to enhance AI productivity with widespread layoffs limited. That being said, AI does have the potential, of course, to automate certain jobs. But on the other hand, we have also seen rising wages for some firms for workers who have skills that complement AI.
Finally, I would like to touch on two things. First, AI can directly impact inflation. For example, in the Mid-Atlantic grid, 70% of energy price increases can be attributed to higher demand by data centers, built specifically for the artificial intelligence. In addition, we would like to mention that if AI were to increase structural unemployment, that is beyond the scope of monetary policy. While we can use monetary policy tools to smoothen the transition as much as we can, if unemployment rate were to rise due to structural effects, that is not something that the Fed can control.
Thank you very much.
Okay, thank you. We're very clear. I also like to follow up on one aspect of your presentation that came up during your AI part, namely the relationship between AI and R star. So what are some other drivers or determinants of R star, and how do you see them evolving? And the second part of that question is, since you mentioned this too, that the estimates of R star, there's a quite range of uncertainty about R star estimate. So what are the dangers for policy of overestimating or underestimating R star?
Yeah, so I can get started on this question. In general, in terms of R star, one thing is that to remember is that it's entirely unobservable. So although the Fed may use it to kind of govern their behavior, it's very, very uncertain. And we've seen Holston, Lawbeck-Williams, and Lawbeck-Williams models at 0.84 and 1.37, but there's also models like the LM model and the DSGE model that forecast R star above 2%. So this kind of uncertainty is emphasizing that we have to be more careful in how we incorporate R star into policy behavior. Another clear indication is through the relationship between R star and consumption smoothing. So if we think about some research by Parker in 2015, he mentioned that lower income consumers and more hand-to-mouth type consumers tend to struggle with consumption smoothing. So if we expect R star levels to remain relatively lower, this would kind of widen this gap and make it harder for would widen this level of inequality.
On top of this, it's important to note, and just going back to the question in terms of what is affecting R star, there's a lot of different factors at play in the current state that make it quite complicated. Two factors that really aren't being talked about, but that we think might be genuine concerns are first, the global increase in financing needs for climate financing. The IMF has estimated that there's $3 to $5 trillion needed to adapt to climate change risks. However, the current global investment is only at 1.5 trillion. What this tells us is that there's a massive increase in demand over the supply, and this is likely to push R star up further as demand increases. While this is a longer term risk, we are likely to see the impacts of climate change happen in the next 5 to 6 years, and this is something that we should be worried about. Another thing, however, that is potentially pushing it down, and this was something that was very popular to consider during the 2010s, was former Chair Bernanke's thesis of the global savings glut, the idea that savings was struggling, and because of that, the R star was decreasing. Both of these factors are likely to play a part. It is unclear to us how exactly we can gauge exactly what is playing a part, but noting that R star is unobservable, the most important thing is that we act with caution and act on what we can see based on the estimates.
In addition, some more downward forces we are seeing on R star include aging demographics and the slowing birth rate. This leads to downward forces on R star because older populations tend to save more. The slowing birth rate leads to a slowing labor supply, and this leads to downward forces on AI. In regards to some more upward forces on R star, in the 1990s during the tech boom, we saw R star increase due to the increase in productivity then. Some more upward forces include the higher fiscal deficits that we are seeing right now.
Lastly, to kind of answer your second question, the implications of overestimating or underestimating R star mean that monetary policy could be too restrictive or too loose compared to the true rate. However, it's important to note that when we're setting near-term monetary policy, we also must react to real-time data about where inflation and the labor market currently are, while R star can provide a good estimate of long-run neutral rate. In the short run, it's important to monitor data.
Thank you very much.
Thank you very much.
Thank you.